my job today is just to fill in between the two companies and give you a bit of an overview about the portfolio as I've done in previous years. And obviously I can't talk about every company within the portfolio. There are roughly 60 in each VCT. So I'll try to give you a bit of a feel for how the VCTs are set up at the moment by looking at a few numbers. The other things I'd like to address are around deal flow, so the investment opportunities that we're seeing, because lots of people ask about whether, in light of the new rules, we're seeing enough good investment opportunities, and I can give you a few examples of what we've been doing recently, and valuations as well, because people are also asking about valuations and whether we feel that valuations are ahead of themselves. And actually, well, I don't know if David is still here, but it's probably worth, whilst IdeaGen is fresh in your mind, just mentioning that IdeaGen has lots of the characteristics that we're looking for when we're investing in companies. So David mentioned the margins, which are very high, and high margins tends for us to mean that the company has a good competitive advantage, and there are significant barriers to entry in that industry. It's operating in what might seem to be quite a dull, but is a market with great structural growth characteristics, with being governance, risk, and compliance. And it has a high degree of recurring revenues. So that de-risks the proposition significantly if at the beginning of your year you can look at your forecasts and say, well, 60% of that is effectively banked already. Anyway, so I'll start on deal flow. This goes back, this is a chart that just shows the investment opportunities that we've screened over the last 4 years. And so the stripy bars here, these are all the deals that have been introduced to us in 2014, 15, 16, and year-to-date 17. And the solid blocks here are the deals that we've actually, the companies we've actually invested in. And so the reason that you see this drop here, so bizarrely, we had exactly 76 in both 14 and 15, and then that dropped in 16 to 35. And that coincided with the new rules around what we could and could not invest in became effective in November 2005. So, 15. So that's really you can see the impact of that in the deal flow that we saw. And there was probably the most common deal type that we used to see that we no longer saw after the change in the legislation was where an AIM company was raising capital to acquire another business, and you can no longer use VCT money to do that. And what we expected in 2016, because of those changes, we expected deal flow to drop, and then we expected it to recover as the brokers who bring us our deal flow started to understand the legislation better and what we were looking for and what we could invest in. And in fact, that is kind of what happened. So in the second half of 2016, deal flow started to pick up, and it's looking a bit healthier now. And we're still not back to 14, 15 levels, but it's improving. And of course, we don't really care how many deals we see. What we care about is the quality of the deals. And you can see that we did 6 deals in 2015, so I guess as a proportion of the total number of deals that we saw, it went up relative to 14 and 15. And the same thing has happened year to date in 2017. And that's, well, I guess it could suggest one of two things. The first thing is that we're being more indiscriminate in terms of what we're buying. But actually, the reason that those ratios are going up is because the quality of deals that we're seeing is actually pretty good. We've been quite pleased about that. So on that, 3 recent investments that we've made. The first one, and these are all in the year, the year ending January 16 in respect of Amati VCT2 and January 17 in respect of Amati VCT2 and February 17 in respect of Amati VCT. So the first one, LoopUp. LoopUp addresses the pain points that we've all experienced with conference calls. So anybody that's that has been on a conference call will recognize these frustrations. And it's things like not knowing who's on the call, not knowing who's dropped off the call, not knowing who's talking, not knowing when to talk, not being able to share documents particularly effectively, not knowing whose dog is barking in the background. All of these pain points are addressed by LoopUp. And LoopUp provides software, a desktop software application. Everybody on the conference call opens up the application. The application calls you when it's time to have the call. It lists everybody on the call when they're on the call. If somebody drops off, you can see that. You can share documents. You can see who's talking. All of that great stuff. And LoopUp was a deal, kind of a classic type of deal that we're seeing, high quality deal that we're seeing since the change in the VCT legislation. So this is a kind of traditional growth or development capital deal. And LoopUp came to raise money. Actually, it came to raise money to pay down some debt and to raise some growth capital as well. And this is not, I think one of the concerns was that with the rule changes, we'd be forced into very early stage companies. And LoopUp is not what I would consider to be a particularly early stage company. It's a well-established business, revenues of just under £13 million, an EBITDA of £2 million, and very nice growth characteristics as well. So that's the type of deal we're looking for. In a similar vein was another company called FreeAgent. And again, talking about pain points, FreeAgent addresses the pain points that people that run very small businesses, mostly freelancers and sole traders, have when it comes to accounting. And you find within these groups of people there's a lack of understanding, or they encounter problems when it comes to bringing their accounts together. And those problems are transferred over to their accountant. And the accountant's worst nightmare is something called a brown paper bag job. And that's when the client hands over the brown paper bag with all the year's invoices and receipts and expenses in them. And the accountant has to wade through that. Now, most people have moved away from that now onto Excel spreadsheets at least, but it's still not particularly efficient. So FreeAgent sells for a modest monthly fee, licenses their software to sole traders, to freelancers, and they input the numbers into the software, and it has lots of useful functionality if you're a sole trader, and then at the push of a button, their accountant can produce their accounts. So there are efficiencies for the business person, and there are efficiencies for that person's or that company's accountant as well. And again, not a particularly early stage company, revenues of £8 million, really nice top line growth. It's still a loss-making company, and that's why it needed to raise some money. It needed some working capital, some development capital to hire more salespeople and to hire more developers. Now, the exception, the third deal, this is the last one I'm going to talk about. The third deal that we did was in a biotech company. And by and large, we don't like investing in biotech companies because they tend to take from the initial concept to generating revenues in a drug discovery company takes a long time and requires a huge amount of capital and depends on a huge amount of variables. And we've never seen them as particularly attractive investment opportunities for those reasons, and probably because we're not specialists in this area either. But Faron was an exception to this, and we did Faron. Faron has a drug for something called ARDS, which is acute respiratory distress syndrome, which stops oxygen getting to your vital organs, and it has a very high mortality rate and no current cure. And Faron addresses this, and Faron, the attractions with Faron were that it is in phase 3 trials at the moment, so it's relatively far down that development pipeline. It's addressing a large unmet need. The data that had come out of the phase 2 trials was very, very high quality. Actually, the drug, I think, had been used in a different formulation for another purpose, so there were no safety concerns. So all of those things, all of those reasons made us decide that this was an interesting position to take in the VCTs, and a nice diversifier as well. We don't really have anything like this, and we're glad we did. It's done pretty well. So that's Dealflow, and Dealflow at the moment is, we think, actually, since the rule changes, has been pretty good. Now, if you've been here before, you may recognize this chart because we update it every year. And what we do here is we take the portfolio of each VCT and we put each stock in a bucket. And the bucket corresponds to the nature of the size of the company. And if you're looking at this chart, there's lots of information on there, but the main thing to understand about this chart is really that in terms of risk, the risk decreases as you go to the right. And what we expect to see on a year-on-year basis is more and more of the companies in the portfolio moving into these categories, into these buckets on the right-hand side of the chart. And the gold bars represent the portfolio as at February 17, and the other bars represent the portfolio at previous years. So what this is telling us is that more and more of the portfolio is moving over to that right-hand side as the companies that we bought years ago for the portfolio start to grow, continue to grow and continue to mature. So that's exactly what we want to see when we look at these slides. That's Amati VCT, and it's a similar story for Amati VCT 2. So we probably buy companies, we're buying companies either in this category here or in this category here, and all going well, these businesses should migrate into this category here and this category here. And then the rest of the portfolio is made up by our UK Smaller Companies Fund and cash. Now, some statistics, I thought it'd be useful just to see, we allude to this in the annual reports, but what went well over the year we've just reported and what didn't go so well. So the biggest contributors to performance were Quixent, which has they've spoken here before, they have the computers that go into casino gaming machines. Quixent made an acquisition. We had a full year contribution from that acquisition, but notwithstanding that, the underlying growth in that business continued to be very, very strong. Keyword Studios, they've also spoken here before. Keywords has a strategy a bit like IdeaGen. They have very good underlying organic growth, and they supplement that growth with acquisitions. And they're good at doing acquisitions. They buy well, they buy the right companies, or history suggests they buy the right companies, and they buy those companies on sensible multiples as well. Craneware, which is, they supply software to US hospitals, and Craneware had, growth had really abated a bit over the last few years, and that strong growth has come back now. It was also a beneficiary from sterling weakness. All of its revenues are booked in dollars, so it benefited from that. AB Dynamics supplies kit to the automotive OEMs, and they supply suspension testing measurement kits, driver robots, and they're really the beauty of AB Dynamics is that the design cycles of a new model of car are so long that the products that AB Dynamics is supplying AB Dynamics as a business tends not to be particularly cyclical, because these products are needed come what may, irrespective of the economic cycle, because these are cars that are being developed over multiple periods of time. And of course, AB Dynamics is benefiting from the move to increasing R&D by the car companies in driver assistance and self-driving. And then IdeaGen, which fortunately is in the winners, not the losers. It would be a bit embarrassing if it was. So you've heard all about IdeaGen, which had a great year. What didn't go so well, which is important to disclose, Bilby is a building services business and gas maintenance business. Bilby contracts with typically local authorities, and one of their big local authority customers took the contract in-house, so they lost a big contract there. Sprue Aegis designs smoke alarms and carbon monoxide alarms. And they had as it says there, they had a battery issue in one of their alarms that resulted in the alarm emitting that irritating chirping noise. Now, it wasn't their battery, but you can imagine that there were product recalls and claims and so on, which set them back. Crawshaw's is a butcher's business. It's difficult to really know what went wrong there. Crawshaw's is expanding through rolling out more butcheries in the Midlands and the north of England, but they're also using initiatives that have been brought in by a relatively recent chief exec appointment to drive like-for-like sales in their stores. So in other words, they're trying to grow the sales on a store-by-store basis. They're trying to grow their sales. And that didn't happen. And they talked about competition from supermarkets getting their product offering wrong. We held on to that. We held on to Bilby as well. And that seems to be recovering somewhat. And we held on to FreeAgent. TLA Worldwide, we actually sold. There was a bid for the company. The bid went away. The company subsequently had some trading difficulties. That's gone from the portfolio. And Polyhedra was a sort of legacy unquoted holding. We had a small bit of value in it during the year, and we wrote that down to nil over the course of the year. They lost their most significant contract. And in Amati 2, very similar story. The only differences here are the biggest contributor to performance in Amati VCT2 was Accesso, which is probably well known certainly to the Amati VCT2 shareholders. It's the largest position outside the fund, the smaller companies fund in the VCT. It had another great year. It benefited from dollar strength. It made another acquisition. That's a company we're still very positive on. And then iDocs was the fifth biggest contributor to performance. iDocs, another software business. They have a local authority business. They license software to local authorities, and they have an engineering software business as well. And they saw some recovery in the engineering business. And similar in terms of the detractors from performance. Rame Energy entered administration. That's the only difference there. So I'm just going to move over this to here. And this is just to give you, what I'd like to do is just give you a kind of a view on as I said, I can't talk about every company, but if we look at the most significant companies in the portfolio in aggregate, how do they look? So the way that I've done this is to look at the top 10s of each of the portfolios. And if you take the top 10 of Amati VCT, if you strip out our smaller companies fund, so if you look at the 10 largest company positions, that's 44%, 44.7% of the overall fund, and for Amati 2, it's 48.4%. So what I'm trying to say here is the fortunes of these companies or the characteristics of these companies are very influential on the portfolio as a whole. The weighted average market capitalization, coming back to a question earlier, is £288 million in Amati 1 and £310 million in Amati 2. And I just looked at net cash as well, so weighted average cash, but the top 10s are on a weighted average basis, are in net cash territory. So if we look now at the fundamentals of the business, so what kind of revenues, what kind of profits are these businesses in the top 10 doing? If you apply the same methodology and you weight the revenues and the EBITDA, earnings before interest, tax, depreciation, and amortization of each of those companies, then you get to a revenue number for this year in Amati VCT, which is this bar here, of £68 million, and Amati 2, £78 million. And if you look 1 year ahead, you get to a revenue number, an estimated revenue figure of 76 million for Amati 1, 88 million for Amati 2. And if you look at EBITDA, those numbers are 15 and 17, and 17 and 20. So I guess what we're trying to say here is that if somebody were to say, what's a typical company in the portfolio, what kind of revenues and profits is that typical company doing? You would say, well, in Amati VCT, it's doing 6 to 8 million of revenue and 15 million of EBITDA, which I think surprises people because VCTs are often associated with having relatively early stage companies, not necessarily profitable businesses. But this is a consequence of our policy of holding on to our winners and holding on to our winners as they become larger and become more mature. Now, on valuations, this is, one of the most commonly asked questions at the moment is whether the market's hugely overvalued. And that's particularly pertinent when you're talking about AIM, where some of the valuations are very elevated. And the purpose here is not to distress you with these high multiples, which do look very high, but it's to try and explain to you how we think about valuation. So if you look at current year earnings, then the top 10, again using this weighted average method, and some of these assumptions we've had to make ourselves in terms of forward earnings and so on. But I think this gives a pretty good picture of it. If you look at current year earnings expectations for the portfolio, for these top 10 companies in each of the portfolios, you get to a weighted average PE multiple of just under 28 times in Amati VCT and 29 times in Amati VCT2. So the first thing to say is that if you were to look at those in isolation, I think most people would conclude, well, the market's extremely expensive. What we do is we look at the multiples relative to the growth that the company can generate. And this is the earnings growth the company can generate. And what this does is that creates a PEG ratio, and which is price earnings to growth. So in other words, we're willing to pay a higher multiple for a higher growth stock. Because if you're to follow this, if you're investing in companies for 5 years, for 10 years, and these are companies with very strong structural growth characteristics, if you model out those earnings over a long period of time, and those earnings at very, very high rates of growth, then that high PE ratio starts to come down pretty rapidly. So EPS growth in Amati VCT is very high, is 33%. This is estimated, and 35% in Amati VCT2. Now, by way of comparison, we can look at the AIM All-Share Index. The AIM All-Share Index looks a lot cheaper, but the estimated earnings growth of the index is a lot lower. And what then happens is these are the PEG ratios here. And people often think about a PEG of 1 when they think about growth companies. So if this company is on a PE multiple of 20, if it's growing its earnings at 20% per annum, then that's a PEG of 1. People tend to think about 1 as a bit of a line in the sand. And you can see that on this analysis, Amati VCT and Amati VCT2 are trading on PEGs of less than 1. And the AIM All-Share is on a much higher PEG. So whilst its PE ratio is much lower, the earnings forecasts in aggregate of the companies in the AIM All-Share are much, much lower as well. So we don't get too distressed or too hung up about the absolute PE ratios. And let me just give you an example of how this works. So this is Accesso, which is a stock in Amati VCT2, which is not in Amati VCT1. But I could just as easily have taken a stock in Amati VCT1, but this just illustrates the point here. The share price of Accesso is just over, when I did this analysis, it was just over £18, and the EPS forecast for the current year is 43p. And so that drives a P of 42 times, which looks very expensive. Accesso has the characteristics. Accesso has a track record of growing at 20, 25, 30, 35%, growing its earnings at that level every year. And if you look at the characteristics of Accesso and the market and the business model and the drivers, the levers it has to pull to grow, this is a company that we can see continuing to grow at these exponential rates for quite a long time. So if you model that earnings number out for those 5 years, 43p becomes 131p of earnings, and therefore that PE ratio falls to 13 times. And this is what we're trying to do. We're trying to look for companies that we want to own for 5 years or 10 years. And what can that company deliver over that period of time? Rather than starting with a business that may look cheaper from a PE point of view, but has much lower earnings growth. That's what we're trying to do here. And that's my time up. So we've got a few minutes for questions if anybody has any questions.
Yes, in the middle here. Yeah.
Whilst I accept what you say about PEG, and is the all-share index, the AIM all-share index, a fair comparison given that it comprises so many mining and oil stocks which are loss-making?
Yeah. Yeah. Well, it's not the best comparison. It's really the best proxy that we have. But I guess in amongst all of those oil and gas and mining companies are some very, very substantial non-resources companies. So if you look at the top of AIM, if you look at the largest companies in AIM, those companies are ASOS, which is online retail, Boohoo, which is also online retail, James Halstead, flooring manufacturer, Fevertree, the drinks business. So whilst I accept there's a reasonably big weighting of resource companies, actually there's an even bigger weighting of those sorts of companies. And as the index is weighted, the fortunes of those companies have a big bearing on the overall statistics of AIM. So it's not a perfect measure, but I think it's a reasonable proxy.
It's worth adding that aggregate PEs tend to exclude loss makers as well. I think I had one more question over. Do we have any other questions for Doug? Yes.
Very well buying companies looking forward so long. Yeah. But how do you assess the risk of things like major IT failures, like BT, reputational risk?
That's a really difficult thing to do. So the question was how we, it's all very well looking 5-10 years into the future when making an investment decision, but how do we assess sort of cataclysmic IT failures and so on, and I think BP was used as an example. I think that what we can deal with, I think our time's better spent dealing with the fundamentals of the business and dealing with the factors that we know and that are to an extent under our control. And I think I guess there are so many imponderables from a massive IT failure to more macro type events like a change in interest rates or a Brexit or whatever that may be. But I think what we find is our energies are better devoted to analysing the company based on the information that we have to hand. And I think maybe you just have to accept that occasionally these black swan type events are going to occur, but they're extremely difficult to foresee.
Thank you. Forgive me, we're gonna run out of time if I don't move on, but I will, if I can, leave a bit more time for questions at the very end. Thank you very much, Doug, for that presentation.